Introduction to Financial Management. Financial management is a critical aspect of running any successful business, regardless of its size or industry. It involves the strategic planning, organizing, directing, and controlling of financial undertakings in an organization. This module lays the groundwork for understanding the fundamental concepts and importance of financial management. Effective financial management ensures that an organization has the necessary funds to operate, grow, and achieve its objectives. For instance, companies with robust financial management often experience 15 to 20% higher profitability compared to those with weaker practices, demonstrating its direct impact on business success. Maximizing shareholder wealth. One of the primary objectives of financial management is to maximize shareholder wealth. This goal involves making decisions that increase the value of the firm, ultimately benefiting its owners or shareholders. Financial managers achieve this by considering factors such as profitability, growth, and risk. Maximizing shareholder wealth is often preferred over simply maximizing profit because it considers the long-term value of the company and the time value of money. For example, a decision that reduces short-term profit but significantly increases future cash flows and reduces risk would be aligned with shareholder wealth maximization. Ensuring liquidity and long-term goals. Maintaining liquidity is crucial for the day-to-day operations of a business. Financial managers must strike a balance between profitability and liquidity, ensuring the organization has enough cash and liquid assets to meet its short-term obligations. This balance prevents operational disruptions and maintains financial stability. Financial management also involves planning for the long-term success of the business. This includes setting ambitious financial goals, creating comprehensive financial plans, and implementing strategies for sustainable growth and market competitiveness. For instance, companies like Apple plan their capital expenditures years in advance to ensure long-term innovation and market leadership. Importance of financial management. Financial management plays a pivotal role in strategic decision-making. It provides the necessary financial information to evaluate potential investments, assess risks, and make informed choices that align with the organization's overall objectives. This ensures that every major decision is financially sound. Effective financial management also ensures optimal resource allocation. This involves distributing funds to different departments, projects, and investments based on their potential returns and contribution to the organization's goals. For example, a well-managed company might allocate 30% of its budget to R&D for future innovation, demonstrating strategic foresight. Overview of financial statements. Financial statements are the lifeblood of financial management, offering a snapshot of a company's financial performance and position. The balance sheet, also known as the Statement of Financial Position, provides a snapshot of a company's assets, liabilities, and equity at a specific point in time. It adheres to the fundamental accounting equation: assets equals liabilities plus equity. Interpreting the balance sheet is crucial for assessing a business's financial health and stability. For instance, a company with a high proportion of current assets relative to current liabilities typically indicates strong short-term solvency. Understanding the balance between these elements helps evaluate the overall financial position. Income and cash flow statements. The income statement or profit and loss statement outlines a company's revenues and expenses over a specific period, reflecting its profitability. Analyzing revenue sources, cost structures, and factors influencing net income helps understand business performance. For example, a 10% increase in revenue might not translate to a 10% increase in net income if operating expenses rise disproportionately. The cash flow statement tracks the inflows and outflows of cash within a business, complementing the balance sheet and income statement. It categorizes cash flows into operating, investing, and financing activities. Effective cash flow management is vital for liquidity, as a company can be profitable on paper but still face insolvency if it lacks sufficient cash. Ratio analysis. Liquidity and profitability. Ratio analysis is a powerful tool for evaluating an organization's financial performance. Liquidity ratios, such as the current ratio and quick ratio, assess a company's ability to meet its short-term obligations. A current ratio of 2:1 is generally considered healthy, meaning current assets are twice current liabilities. Profitability ratios measure a company's ability to generate profit relative to its revenue, assets, and equity. Key ratios include gross profit margin, operating profit margin, and net profit margin. For example, a high net profit margin indicates efficient cost management and strong pricing power. Ratio analysis, leverage and efficiency. Leverage ratios assess the extent to which a company relies on debt financing, providing insights into its financial risk. Ratios like the debt-to-equity ratio and interest coverage ratio are crucial. A high debt-to-equity ratio, for instance, might signal higher risk to investors, as the company relies heavily on borrowed funds. Efficiency ratios evaluate how well a company utilizes its assets to generate sales and manage liabilities. Examples include inventory turnover, accounts receivable turnover, and asset turnover. A high inventory turnover, for example, suggests efficient sales and inventory management, minimizing holding costs and maximizing cash flow. Importance of budgeting. Budgeting is an integral component of financial management, providing a roadmap for organizations to achieve their financial goals. It serves as a strategic planning tool, allowing companies to set financial objectives and allocate resources efficiently. This ensures that financial resources are directed towards achieving long-term success. Budgets also provide a benchmark for evaluating actual performance against planned performance. Budgetary control helps identify variances, enabling timely adjustments to operations and ensuring the organization stays on course to meet its financial objectives. For example, a company might find that its marketing budget was underspent by 15%, prompting an investigation into campaign effectiveness. Types of budgets. There are several types of budgets, each serving a distinct purpose in financial management. Operating budgets outline expected revenues and expenses for a specific period, including sales, production, and overhead budgets. These are crucial for managing day-to-day operations and short-term profitability. Capital budgets focus on long-term investments in assets like equipment, facilities, and technology. They involve evaluating projects using criteria such as net present value, NPV, and internal rate of return, IRR. Cash budgets, on the other hand, project expected cash inflows and outflows, ensuring sufficient cash for obligations and liquidity management. For instance, a large manufacturing firm might use a capital budget to plan for a new factory expansion over 5 years. Forecasting techniques. Forecasting techniques are essential for navigating an uncertain business environment. Time series analysis involves studying historical data to identify patterns and trends, which can then be used for short-term and long-term predictions. This method is particularly useful for predicting seasonal sales or recurring expenses. Regression analysis is a statistical method for predicting the relationship between variables. Participants learn to use this technique for forecasting, understanding its limitations and assumptions. For example, a company might use regression analysis to predict sales based on advertising spend and economic indicators. Qualitative methods and emerging trends. Qualitative forecasting methods involve subjective judgments and expert opinions, incorporating insights that quantitative data might miss. Techniques like the Delphi method and market research gather expert consensus or consumer sentiment. For instance, the Delphi method can be used to forecast the adoption rate of a new technology by surveying industry experts anonymously. Emerging trends in budgeting and forecasting include rolling budgets and beyond budgeting approaches. Rolling budgets continuously update as time progresses, offering flexibility in dynamic environments. Beyond budgeting emphasizes flexibility, decentralized decision-making, and a focus on key performance indicators, KPIs, over fixed annual budgets, allowing for greater agility. Identifying financial risks. Risk is an inherent part of business, and effective financial management involves identifying, assessing, and mitigating various types of risks. Market risks encompass factors such as changes in interest rates, exchange rates, and commodity prices. For example, a sudden rise in interest rates can significantly increase a company's borrowing costs. Credit risks arise from the possibility of customers or counterparties defaulting on payments, while operational risks result from internal processes, systems, and human factors. Strategic risks involve threats to the overall business strategy, such as shifts in consumer behavior or competitive landscape. Identifying these risks early is crucial for financial stability. Strategies for risk mitigation. Risk mitigation involves implementing strategies to reduce the impact or probability of identified risks. Risk avoidance means eliminating or avoiding certain risks altogether, such as choosing not to enter a volatile market. Risk reduction focuses on minimizing impact through diversification or process improvements, like implementing robust cybersecurity measures to reduce data breach risks. Risk transfer involves shifting the financial burden of risks to another party, often through insurance or contractual agreements. Risk retention, conversely, means accepting certain risks and bearing the associated costs, typically for minor or unavoidable risks. For instance, a company might retain the risk of minor equipment breakdowns, but transfer the risk of major natural disasters through insurance. Overview of insurance products. Insurance products provide crucial financial protection against various risks. Property insurance covers physical assets like buildings, equipment, and inventory against perils such as fire or theft. Understanding policy limits and covered perils is essential for selecting appropriate coverage. Liability insurance protects against legal liabilities arising from injury or damage caused to third parties. This includes general liability, professional liability, and product liability insurance. For example, a construction company would need robust general liability insurance to cover potential accidents on job sites. Life, health, business interruption insurance. Life and health insurance provide financial protection against risks associated with death, illness, or disability. These policies offer peace of mind and financial security for individuals and their families. For instance, a critical illness policy can provide a lump sum payment upon diagnosis, helping cover medical expenses and lost income. Business interruption insurance covers financial losses incurred due to disruptions in normal business operations, such as natural disasters or fires. It helps maintain financial stability during unexpected events by covering lost profits and ongoing expenses. This type of insurance is vital for business continuity, ensuring a company can recover and resume operations after a significant setback. Risk management planning. Risk management planning involves a systematic approach to identifying, assessing, and developing strategies for various risks. Practical exercises often include scenario analysis and risk mapping to quantify potential impact and likelihood. This structured approach helps organizations prioritize and address the most critical risks. Developing a comprehensive risk management plan outlines strategies for mitigating, transferring, or retaining specific risks. It also establishes protocols for monitoring and updating the plan over time. Integrating risk management with overall financial planning ensures that mitigation strategies align with the organization's financial goals and objectives, creating a cohesive approach to financial stability. Capital budgeting importance. Capital budgeting is a critical process for organizations to make informed investment decisions that align with their strategic goals. It involves evaluating and selecting the most profitable and strategically sound investment opportunities. This process is essential for allocating resources efficiently and maximizing shareholder wealth. Capital budgeting ensures the long-term sustainability of an organization by guiding investments in projects that generate future returns. For example, a company deciding whether to invest in a new production line or expand into a new market would use capital budgeting techniques to assess the financial viability and strategic fit of each option. Types of investment projects. Investment projects can be categorized into several types, each with unique characteristics. Expansion projects aim to increase an organization's production capacity or market reach, such as building a new factory or acquiring a competitor. These projects are often driven by growth objectives. Replacement projects involve replacing existing assets with newer, more efficient ones, like upgrading old machinery to reduce operational costs. New product launches focus on developing and introducing new products or services to the market, requiring significant investment in research, development, and marketing. For example, an automotive company's decision to develop an electric vehicle line would be a new product launch project. Capital budgeting techniques. Net present value, NPV, is a fundamental capital budgeting technique that calculates the present value of expected cash inflows and outflows. The positive NPV indicates a profitable project, as it means the project's expected returns exceed the cost of capital. For example, if a project costs $100,000 and is expected to generate future cash flows with a present value of $120,000, its NPV is $20,000. Internal rate of return, IRR, represents the discount rate at which the NPV of an investment project is zero. It is used to compare and select projects with higher IRRs generally preferred. The payback period is the time it takes for the initial investment to be recovered, offering a simple but limited tool for assessing liquidity and risk. The Profitability Index, PI, is the ratio of the present value of cash inflows to outflows, complementing NPV by showing the value generated per dollar invested.